Okay, so let's start with FSA revision now. Introduction to financial statement analysis. What are the components of financial statements? Balance sheet, also called as statement of financial position. Income statement, that is the P&L, profit and loss account. Cash flow statement. SOCI, statement of changes in equity. Notes to accounts. And one more thing, OCI, other comprehensive income. Yes? Okay, what all goes in balance sheet? Assets, liabilities and owner's equity. If you want to see the position of the company, see the balance sheet. But if you want to see the performance of the company, see the income statement. Income and expenses, recurring income and recurring expenses form a part of P&L. Okay. Cash flow statement, actual cash inflows and outflows form a part of cash flow statement. What all goes in SOCI? Whatever transaction the company does with the shareholders of the company form a part of SOCI. So remember, dividends paid will never form a part of P&L because it is not an expense for the company. It is simply a return of capital to the shareholders. So it will be a part of SOCI. New shares issued, shares buyback will form a part of SOCI. Okay. OCI, usually those things go in OCI which do not disturb the P&L, which do not affect the operations of the company in the near term. So as we discuss all the chapters, we'll discuss what all goes in OCI, and notes to accounts are the most critical part of any financial statement, right? Balance sheet P&L usually is what, a one pager, but if you want the detailed breakup of those items, you go where? Notes to accounts. Okay, which accounting policy, which accounting estimate the company is adopting, everything will form a part of notes to accounts. Practically I had shown you a lot of notes to accounts, so you must be remembering. Okay, fine. Now steps in financial statement analysis. If you want to analyze financial statements, we had learned 6 steps. Step 1, state the objective and context. What is the purpose of your analysis? You may be a debt investor, you may be an equity investor, so your देखने का नजरिया तुम्हारा अलग हो सकता है. ओके. सेकेंड स्टेप इज व्हाट? कलेक्ट डेटा. You collect data, lot of unwanted data also may be there. So in third step, you what? Process the data. Process the data may you convert everything into a common size basis and all for your better analysis. Common size income statement, common size balance sheet. Tell me, common size income statement, every item is converted as a percent of sales. Common size balance sheet, every item as a percent of total assets, or maybe even total liabilities, because total assets and total liabilities, the total has to match. Okay, and when I say total liabilities, you have to understand it is total liabilities plus shareholders equity, which will form a part of total liabilities. Okay, fine. You do all this in process data. Then fourth step is what? Why did you do all this? Ultimately to be able to analyze. So fourth step is analyze the data. Fifth step is conclusion. Ultimately all this hard work was so that we could conclude. So fifth step is conclusion, and sixth step is what? Follow up, data updation, because data becomes stale in no time. So you have to continuously update your data so as to remain in touch with the current data, right? Okay, and always remember one thing, the output of one step forms the input of next step. Could be testable, please be very careful. So output of processed data is an input of analyzed data, right? Okay, then we had discussed a little bit on auditor. An auditor audits the accounts of the companies. Accounts are prepared by whom? First of all, management. Okay, management prepares the accounts, called as financial reporting. And who audits it? The auditor. Auditor is appointed by whom? The management or shareholders? Shareholders appoint the auditor. Auditor gives what? A reasonable assurance, always a reasonable assurance and never an absolute assurance. It's practically not possible. Okay, which are the two types of accounting standards? IFRS and US GAAP, which are globally followed. IFRS, International Financial Reporting Standards. US GAAP, US Generally Accepted Accounting Principles. IFRS is developed by which entity? IASB, International Accounting Standards Board. US GAAP is developed by which entity? FASB, Financial Accounting Standards Board. Okay, now these standard setting bodies are only responsible for setting the standards. They are not responsible to enforce compliance. The responsibility of enforcing compliance rests with the regulatory bodies like SEC, Securities and Exchange Commission, SEBI in case of India, Securities and Exchange Board of India, etc. Now auditor, what is the primary responsibility of an auditor? To detect fraud or to check whether the accounts have been prepared in accordance with the applicable accounting standards? the latter one, to check whether the accounts have been prepared in accordance with the applicable accounting standards. That is the primary responsibility of an auditor. Now, detecting fraud, I wouldn't say as the primary responsibility. During the course of my work as an auditor, if I find something fraudulent, I might dig deeper, but primary objective is never that. Once I complete my audit, I give what? Opinion. So in my audit report, there has to be an opinion paragraph. Then I have to explain the basis for opinion. So basis for opinion paragraph will be there. I had shown you. Okay. What are the types of audit opinions? Testable. One is unqualified opinion. The other is modified opinion. Unqualified opinion is clean opinion. Okay. Modified opinion had three other types. One was qualified opinion, that the company has not adhered to the accounting standards with respect to one or two items. That is when the auditor gives a qualified opinion. The second type of opinion under modified opinion was adverse opinion. The company has not adhered to accounting standards at all. And the third type was disclaimer of opinion. The auditor faces significant limitation on the scope of his work. That is when the auditor gives a disclaimer of opinion. Yes? Okay. As I said, unqualified opinion is always desirable. Okay. Now, these entities, listed companies, is audit optional or compulsory? Compulsory. And moreover, these listed companies, they have to give interim results. Interim results matlab quarterly results. Tell me, those quarterly results, are they audited or unaudited? Unaudited, because practically it's not possible to conduct quarterly audits. So those are unaudited. Audit has to be conducted at least at an annual frequency. Remember that. Okay, fine. Now, as regards P&L and balance sheet, P&L is always for a particular year, remember, and balance sheet is always as on date. So there is a timing mismatch between balance sheet and P&L. Okay. Now, if you want other data about the company, financial statements will give you a lot of info about the company. Annual reports, you can get other data like management commentary, management discussion and analysis, which will usually be at the starting pages of an annual report, and much other data. Apart from that, apart from the annual report, can you get data from other sources? Yes. Proprietary sources we had learned. Proprietary sources matlab paid sources, public third party sources, free sources, company website, then regulators website, you can get data. Proprietary sources mein we had learned research reports, Bloomberg terminal and all. If you want to pay, you have to. If you want to take, you have to pay for it. Okay, fine. Now, as regards the segment information, I had given the example of ITC for different business segments. Each business segment should contribute at least 10% to total sales of the company, and collectively they should contribute 75% to total sales of the company. This is called segmentation by business. If you don't want to see as a percent of total sales, you can see as a percent of total assets also. That business segment should contribute at least 10% to total assets, or collectively 75% to total assets of the company. Segmentation can be either done by business or it can be done by geography. Okay. Fine. And as regards segment info, you have to present sales info segment wise. You have to also present what gross profit info segment wise. COGS info is not required to be presented segment wise. Remember that. Okay. Then we had done something called as proxy statement. Proxy statement is when I will give you, as a company, I will give you notice of an AGM, invitation for an AGM. In that proxy statement will basically mention what the agenda of the meeting, who is going to be elected in the directors, who are standing for elections, etc. What are the qualifications, proposed remuneration, all those details, so that it becomes easier for you to vote at the AGM. Okay, advance notice has to be given for an AGM. Remember that, annual general meeting. Apart from this, I think first chapter covered only this much. Anything else that I'm missing out on? Please let me know. And one more thing, it's not advisable to remember the form numbers and all, form 3, form 4, form 10K and all. Once you may just read it, but don't remember it. Okay, fine. Now moving on to the next chapter, income statements. This was a relatively bigger chapter. Let's discuss. Income statement mein, let's start with the top, sales, revenue recognition. There were 5 steps in revenue recognition. Step number 1, identify the contract. Step number 2, determine the performance obligation. Step number 3, determine the transaction price. Step number 4, allocate the transaction price among the different performance obligation. And step number 5, and the final step, record revenue as and when the respective performance obligation is done. Now we had discussed extensively on what is performance obligation. It could be on a case by case basis. I had shown you the notes to accounts. Sometimes it could be so that once the goods leave my factory, the performance obligation is said to have been completed. If the goods, in other cases, it might be so that once the goods reach the customer's factory, that is when the performance obligation is said to be completed. Now, how do I know what constitutes performance obligation? That's the reason step number 1, identify the contract. That will tell you, okay, what exactly is performance obligation, and that is when you recognize revenue. Fine. Okay, then we had discussed several cases. So if it is a long-term obligation, will you wait to record revenue? No, you cannot wait to record revenue. So that is when we follow what percentage completion method. I had given you the example of a contractor, Bandra Valley Ceiling. Okay, so for example, total revenue expected is 500 crores. Total cost you are estimating. See, it has to work on an estimated basis because actual cost, so even you would come to know only with time. So estimated total cost are like, let's say 400 crores. In first year, you have incurred an expense of 100 crore, which you would know on an actual basis at the end of year 1. So 100 by 400 crore, you have completed 25% of the work. So you can record revenue to the extent of 25%. So 500 crore total revenue into 25%. So 125 crore, you can record it as revenue, and the cost which you have incurred on an actual basis, 100 crore, that you will debit it to P&L. Right? That is how percentage of completion method is done. Now subsequently, can my estimations undergo changes? Of course, they can undergo changes. There could be inflation, so that the cost of material goes up, etc., whatever reason. And I had taught you that whenever there is a change in accounting estimates, you always give a prospective effect. So you have to change from second or whichever year the estimate changes, that year onwards you will have to make the changes. Don't touch the previous financial statements. Retrospective application only has to be given in case of change in accounting policy, and that too for all the prior years, or only that information which is presented in financial statements. Only that information which is presented in financial statements, comparative info which we call it. So retrospective application in case of a change in accounting policy has to be given only for comparative years, not for all prior years. Remember that. Okay, coming back to revenue recognition, we discussed percentage completion method. Now at times what may happen is I may not have an estimate of the total cost that could be incurred, and it's a long-term contract. So in that case, accounting standards tell you that whatever cost you have recorded, you will know the cost on an actual basis. Towards the end of year 1, you record revenue exactly equal to the cost. Okay, fine. That is when you don't have an estimate. Okay, when you have an estimate of the total cost, that is when we follow the first method, percentage completion method. I hope this is clear. Okay, then we had discussed about principal and agent. A principal is someone who bears the risk of unsold inventory. Yes. An agent is someone who does not bear the risk of unsold inventory. Principal does not get a commission. Principal buys at a low price and sells at a high price. So a principal's profit and loss account, you would record sales and COGS, corresponding COGS. But when it comes to an agent's profit and loss account, an agent simply receives what? Commission. So you have to only record commission in P&L credit and all the incidental costs there too to receive that commission, right? Okay. Then we had discussed about software also. So for example, I'm in the business of selling softwares and I sell software. That's it. That's my performance obligation. I record revenue as and when my performance obligation is done. But say for example, I sell software and as a bundled service, I also sell that thing in updations and all. So 5 years tak whatever new updates come, I will provide those updates to you in this bundled service. So I cannot record the revenue in one shot because my performance obligation is yet to be done. As and when I provide the installation, the updation, that is when I can proportionately record the revenue, because performance obligation will be done only at that point of time once I provide the updations, right? Okay, fine. Thereafter, after revenue recognition, we had discussed change in accounting estimate, change in accounting policy, which I discussed in due course. And after that, we had jumped to EPS, earnings per share. Now, before discussing EPS, What are the two types of capital structure? Simple capital structure and complex capital structure. In case of simple capital structure, there are no potentially dilutive securities. But in case of complex capital structure, there are potentially dilutive securities like convertible bonds, convertible preference shares, warrants. All these are what potentially dilutive. So in case of simple capital structure, can I say basic and diluted EPS will be the same? See, there won't be any actually diluted EPS, there won't be. But for the purposes of reporting, we will report it as the same as basic EPS. Okay. In case of complex capital structure, we will have to calculate diluted EPS, and we had practiced a lot of questions in class. So for the purpose of computing diluted EPS, I had given you one instruction. First, always calculate the basic EPS. Then one shortcut I had given you, savings upon new shares. You have to check that. If savings upon new shares is less than basic EPS, means it is dilutive. That security in question is dilutive. But if savings upon new shares exceeds the basic EPS, that security in question is anti-dilutive. Do not include that in diluted EPS calculation. Now there was no such question anywhere which involves more than one securities together, but you know, we had taken one question in class where there were three securities: convertible bonds, convertible preference shares, warrants, everything taken together, and we had solved that question. So please be very careful about such questions, nowhere given. Okay, fine. What if diluted EPS is let's say basic EPS is 2, diluted EPS comes to 2.2, means it is what? Anti-dilutive. The securities in question are anti-dilutive, restricted to basic EPS only. Okay, fine. Now many people tend to by heart this when to subtract preference dividend and all. Please understand it logically. In basic EPS calculation, net income minus preference dividend, if any, divide by weighted average number of equity shares. Always weighted average number. Okay, and in weighted average number of equity shares also, what is so important? The stock dividend adjustment. Stock dividend, even if paid during middle of the year, remember we used to take it from start of the year for those shareholders who were shareholders from beginning of the year, and those shareholders who were say shareholders from 1st April, we used to consider stock dividend backdated. I had told you the logic why, because it's given to those people who are shareholders right from that date. Okay, fine. In case of share buyback, do you add to the shares or subtract it from the shares? Subtract it from the shares, remember that. In case of stock split and all, say if there is 2 for 1 stock split, matlab one share is converted into 2 shares, you accordingly multiply all the shares by 2. So that is how you give the effect of stock split to all the shares. This is how basic EPS is calculated. So basically the aim of basic EPS in the numerator is to see funds available, the profits available to common shareholders. That is why you subtract preference dividend if any. Now in diluted EPS, let's say I have convertible preference shares and that convertible preference share is dilutive. Okay. So what I will do while calculating diluted EPS in the numerator, net income, say I won't subtract only preference dividend because it would then result in savings. So understand it logically like that. In denominator, whatever the existing common shares were there, plus I will add new shares which will be given to preference shareholders, right? Okay. In case of convertible bonds, assuming it is dilutive and I am calculating diluted EPS, in the numerator net income, plus I will add back interest but on a net of tax base. Here I need to add back interest because net income excludes the effect. Interest is subtracted in net income. Since it is resulting in a savings after convertible bondholders will become shareholders, so I add back the interest. Since net income is net of tax, that is why interest also I have to add back net of tax. Remember that. Okay. And divide by existing common shares which were there plus new shares given to convertible bondholders. Do you recollect all this? Okay. Thereafter we had discussed warrants. Warrants is only one such product where there was no adjustment in numerator at all. Because were you giving as a company anything to the warrant holders? No, you don't pay interest to the warrant holders, neither do you give them dividends. So there is no question of adjustment in the numerator. Warrants ke liye there was one formula, average market price minus exercise price upon average market price into number of warrants, also called as number of options, one and the same thing. And this formula please apply only if average market price exceeds exercise price. That is when it would make sense for the warrant holders to exercise their warrants. and buy the shares at a predetermined exercise price, right? Which would result in dilution. Remember one thing, warrants if exercised always result in dilution because there is no adjustment in numerator. Okay, fine. This was all about the EPS that we had discussed. Do you have any specific doubts in EPS? Okay, practice a lot of questions pertaining to EPS. Fine. Okay. Thereafter, what else had we discussed in income statements? Capitalizing and expensing. Okay. Now, what do you capitalize and what do you expense? Logically understand this, that whatever expense was necessary to bring the asset to working condition and which enhances the performance of the asset, you have to capitalize those expenses. Installation charges, expense or capitalize? Capitalize. It was necessary to bring the asset to working condition. Then freight inwards, capitalize. Testing charges, capitalize. Necessary to bring the machinery to working. Manpower training charges, expense. It's moreover a recurring expense. It is not enhancing the efficiency of the machinery. So you please expense it off. As regards interest on loan, there was one specific treatment. Interest till the time machinery is getting ready for use, you capitalize that interest, borrowing cost which we call. And thereafter, once the machinery is ready for use and still if you are paying any interest, then you expense it. Okay. One thing which is not given in your books, but you should know this, that if there is any interest income, till the time machinery is getting ready for use, any incidental interest income, you subtract it from the cost of asset. Once the machinery is ready for use, thereafter any interest income, you credit it to P&L. Okay, fine. So this was the treatment of expensing versus capitalization. Fine. Then this thing, expensing versus capitalization, you remember I used to have implication on ratios. So what we have observed in FSA is that a lot of ratio based questions could be tested, because anything that you do, any accounting treatment that you do, it ultimately has implication on ratios. So just to give you an example, net profit margin will be higher where in expense or capitalization in first year. It will be higher in capitalization because all your expenses are getting added to the cost of asset. So your net income is higher to that extent. So net profit margin will always be higher in case of capitalization in the first year. But subsequent year onwards, the net profit margin in case of capitalization would be lesser. Why? Because you have capitalized the asset to such an extent, the total cost of the asset has gone up. Higher the cost means higher the depreciation. So that is why, keeping all other things constant, net profit margin would be lower in subsequent years in case of capitalization. So these are the things that I'm expecting you to be careful about, the ratios basically. Debt to equity ratio, first year. See, your expensing versus capitalization decision is not going to affect your debt, but it is certainly going to affect your equity. In first year, we just discussed, in case of capitalization, equity will be higher because profit is higher. So debt to equity, since equity is higher, debt to equity ratio as a whole would be lower in case of capitalization in first year, and in case of expensing, debt to equity ratio would be higher. Okay, please be very, very careful. I again repeat. Fine. Anything else in this chapter? Depreciation. Okay, fine. Straight line and written down value, most basic methods of depreciation. It is the company's choice which method of depreciation it wants to follow. Whichever method it follows, it will be mentioned in notes to accounts. We had learned one new method of depreciation, double declining balance method of depreciation, where the machinery may be used heavily initially. That is when you follow double declining balance method of depreciation. Also remember one thing, do you ever depreciate beyond the salvage value? Never. Okay. Now I had taught you one CalC shortcut to calculate depreciation as per double declining balance. Please, all the CalC shortcuts, treat them very important. Okay, very important. Okay, so please be very efficient with your calculator usage. Thereafter, we had learned units of production method. Units of production method. So units of production method was what? Original cost, cost, it will be what? Cost minus salvage into units manufactured in current year upon total expected capacity. Yes, it can be in terms of number of units, it can be in terms of number of hours machinery used in current year in numerator upon total expected hours of the machinery in denominator. This is what units of production method. Okay, depreciation is for what? Tangible assets. Depreciation is for tangible assets, amortization is for intangible assets, and depletion is for wasting assets like mines and all that. Okay, fine. This method typically is followed in case of depleting assets, wasting assets like mines and all, units of production method. Okay. Anything else? Research and development. Okay, research and development. The treatment as per IFRS and US GAAP was different, if you remember. In IFRS, research expenses have to be expensed off. Put it in P&L as an expense. Development expenditures have to be capitalized as per IFRS, but only if those four conditions are satisfied. In no particular order, let's discuss those four conditions. Technical feasibility of the product is there. Resources exist to complete the product. The firm has the intention to complete the product, and the firm ready market exists to buy the product. Okay, if these four conditions are satisfied, by the way, tell me one thing, all these four conditions need to be satisfied or any one condition also? All these four conditions need to be satisfied, then only you can call it a development phase. And once any expenditure is incurred during the development phase, as per IFRS, it has to be capitalized. I had given you an example of a pharma company. It hadn't received the marketing approval, because of which we said that ready market does not exist, and that is why the development phase was not yet started. So still whatever expenditure it was incurring was assumed was to be expensed. Please watch the recorded lecture in case you have forgotten. I have discussed all this. I had shown you practically also how it works. So this was about research and development. But US GAAP, the treatment was super simple, no complication. Both the research and development expense have to be expensed off. Nothing has to be capitalized. But there was one exception, software. In US GAAP, anything research expenditure pertaining to software has to be expensed, but development expenditure has to be capitalized. Okay, fine. Just remember one thing, that if the software is being developed for internal use, I need not check that condition whether a ready market exists, because I don't want to sell it. Fine. So one condition gets reduced. Okay, fine. This was the treatment of R&D. Okay. Anything else that we are missing out on in this chapter? Please let me know. Okay, discontinued operation. Discontinued operation is what? See, from the date I decide to discontinue the business till the time I actually sell the business, that period is called what I had told you, phase out period. Now whatever income and expenses relating to phase out period, can they be shown together along with continuing operations, or should they be shown separately? They should be shown separately below continuing operations as a part of profit or loss from discontinued operations net of tax. Okay, and there was one separate line item also on the P&L called as exceptional items. Exceptional items typically are non-recurring items, so again show them separately so that a user understands what pertains to the core business operations and what are one-off events. Just today I showed you that adjusted profit, adjusted return on equity, all that. Why was it important? Because exceptional items effect was removed. Okay, fine. Because an analyst only wants to focus on the core business operations which are recurring in nature. Recurring PAT I had shown you, recurring profit after tax. Okay, fine. Anything else? Discuss changes in accounting policies and estimates. Already discussed changes in accounting policies, what? Retrospective effect only in comparative years, and changes in accounting estimates to be given what? Prospective effect. Now let's discuss a new chapter, balance sheets. Okay, balance sheets mein again that research and development was getting repeated, so I'm not discussing that. Now the focus here was on Non-current assets particularly. Non-current assets, I would divide it into two types. When it comes to assets, long-term assets, tangible, intangible. Intangible also of two types, internally developed, externally developed. Externally developed also of two types, ones with definite lives, ones with indefinite lives. Okay, now let's focus on intangible assets. Internally developed, example of internally generated goodwill. So if you look at the standalone balance sheet of a particular company, you will never see a single rupee of goodwill there because the value cannot be estimated with certainty. Okay, fine. Now externally developed intangible assets. Let's take first an example of definite lives assets, patents, copyrights, trademarks. You purchase it, right? You pay for it. So those are this category. Indefinite life assets, externally developed, purchased goodwill acquiring out of a business combination. So how do you determine that? The excess of purchase price paid over what? Book value of net assets or fair market value of net asset? Always fair market value of net assets. Okay, minus, you have to subtract one more thing, previously unrecognized intangible assets. Anything over and above that will be attributable to goodwill. But if, say for example, purchase price is less as compared to fair value of the net assets acquired, then it represents what? A gain for the company, and it is called bargain purchase. And if you see goodwill will always appear on consolidated balance sheet, never on the standalone balance sheet. Okay, and once you see goodwill, you should understand that company in question may have acquired other companies. Yes, okay, may have acquired me. It has acquired other companies. That is when goodwill appears on the balance sheet, on console balance sheet. Clear with this? Okay. Here again, there was some part of long-term assets chapter which I would like to discuss here only because it is related to this. If there is an asset, intangible asset, which I can renew indefinitely at a minimal cost, you do not amortize it. You do not amortize it. Remember that? Okay, fine. Any doubts in this part? Fine. Do you amortize goodwill? Never. You never amortize goodwill simply because it is an asset with indefinite life. You just have to test it for impairment. Impairment of intangible assets as a concept is not covered at level 1, so not discussing that. Okay. So this was about the assets, long-term assets. I had told you specifically, when you read this chapter, do not read deferred tax liabilities, deferred tax assets. We have a separate chapter for that wherein you would understand better. Okay, fine. Apart from this, we had discussed common size balance sheet here, and then we had started ratios also in this chapter. Solvency and liquidity ratios. Solvency ratios measure a company's long-term ability to fulfill the obligations. Liquidity ratios measure a company's short-term ability to fulfill the obligations. Liquidity ratios may we had done current ratio, which is current assets upon current liabilities. Quick ratio, also called as acid test ratio. Cash plus marketable securities plus receivables upon current liabilities. Do not include inventory because it may not be quickly converted to cash, and in cash ratio it is only cash plus marketable securities upon current liabilities. In solvency ratios we had done debt to equity ratio, and in debt what do you consider? Short term, long term, both? Yes, both, but only that debt which is interest bearing in nature. Now since you know the concept of leases also, please include leases also because that is interest bearing debt. Okay, fine. Then when they say only total debt ratio, it is what? Debt upon assets, debt to assets ratio. Okay, then we had learned financial leverage ratio, assets upon equity. All these ratios, solvency ratios, the lower they are, the better. Means indicating the company is more solvent. The more they are, the company is moving towards the path of insolvency. Lenders would perceive the company as less creditworthy and moving towards the path of insolvency. Interest coverage ratio, EBIT upon interest. Now here one thing we had specifically discussed, Which interest to include? Only the one appearing in P&L or also the capitalized interest? Also the capitalized interest has to be included in the denominator. Please be very careful about this. Then fixed charge coverage ratio in solvency ratios. EBIT upon interest, your normal interest coverage ratio, plus in both numerator and denominator you add back the lease payments. I told you the logic of why do we add back both in numerator and denominator. Okay, this was the fixed charge coverage ratio. Also in liquidity ratios there was one more defensive interval ratio. Cash plus marketable securities plus receivables. The numerator is the same as quick ratio upon average daily cash expenditures. So we are checking whether the company has enough quick assets to meet its average daily cash expenditures, right? Okay. Then most important part of this chapter that we had discussed was when a company invests in shares and bonds of other companies, what is the accounting treatment? US GAAP, three possibilities: held for trading, available for sale, held to maturity. Now when I discuss about equity shares, in US GAAP only one treatment is allowed, held for trading. Equity shares cannot be classified as available for sale, and logically speaking they cannot be classified as held to maturity because equity shares do not have a maturity date, right? But when it comes to debt securities under US GAAP, I can classify it under any: held for trading, available for sale, and held to maturity. Now when I want to change the classification for debt securities, I can change the classification, okay, if the business model test is satisfied. Now not discussing too much on business model debt, it is a part of level 2. Point is, can equity classification be changed? No, in US GAAP only one classification is allowed, which is held for trading. So what is the question of changing the classification? Not possible at all. Okay, fine. Why was this classification important? Because accounting treatments were different. If it is held for trading, be it debt or equity securities, any unrealized gains or losses go where? P&L, profit and loss account. When the debt securities are classified as available for sale, any unrealized gains and losses go where? OCI. But realized gains and losses of debt securities will go to P&L even though if it is available for sale. And held to maturity debt securities are always carried at amortized cost, so their unrealized gains and losses are to be ignored. Any interest and dividends received will go to P&L. Clear treatment, clear? Now let's discuss about IFRS. IFRS also had three classification: FVTPL, fair value through profit and loss; FVOCI, fair value through other comprehensive income; and HTM, held to maturity. Now in IFRS, equity securities can be classified in two ways: FVTPL or FVOCI. IFRS allows in both. HTM not possible because logically they don't have a maturity date. Debt securities can be classified in either of the three: FVTPL, FVOCI, or held to maturity. Yes, any unrealized gains and losses on FVTPL securities should go through P&L. Realized gains and losses, P&L. FVOCI, very important. Let's stress on this. When it comes to equity securities, unrealized gains and losses will go in OCI if it is FVOCI. Also realized gains and losses will go in OCI. Very important. I had shown you practically that also. When it comes to debt securities, if it is FVOCI, unrealized gains and losses will go in OCI, but realized gains and losses for debt securities will go to P&L. Okay, and HTM, it is carried at amortized costs, so you ignore the unrealized gains and losses. As regards the interest and dividends received, it will always form a part of P&L. Clear? Okay, about derivative securities, FVTPL, okay, and HFT. Fine. Any doubts in this? All clear? Now at times in the options they may give retained earnings, so you understand it is net income, so P&L basically. Okay, fine. Anything else that you need to know, or any doubts that you may have in this chapter? Please let me know. Okay, now comes a very interesting chapter, cash flow statement. Very fun chapter. मजा आता है क्वेश्चन सॉल्व करने में. So which are the three types of cash flows? Operating cash flow, investing cash flow, financing cash flow. Anything pertaining to day-to-day business operations will go to operating cash flow. Anything pertaining to non-current assets of the company will go to investing cash flow. Anything pertaining to non-current liabilities will go to financing cash flow. Yes, bonds issued, financing, shares issued, shares buyback, loan repaid, everything financing. New asset, plant and machinery purchase, plant and machinery sold, everything forms a part of investing. Sales, purchases, everything forms a part of operating. Money received from debtors, money paid to creditors, again operating. Clear? Okay. When it comes to interest and dividends, highly testable. Different accounting treatments under IFRS and US GAAP. In US GAAP, everything interest paid, dividends received, interest received, operating. Only dividends paid will form a part of financing. In IFRS, I had told you one simple technique to remember: whatever is logical / operating. In every case, interest paid logically should go where? Financing / operating. Interest received, investing / operating. Dividends received, investing / operating. Dividends paid, financing / operating. This was the difference. Also, there is a difference in IFRS and US GAAP with respect to the tax treatment. Under US GAAP, all the taxes paid will form a part of operating cash flows. But under IFRS, taxes pertaining to operating activities will go in operating cash flow. Taxes pertaining to investing activities will go in investing cash flow. Taxes pertaining to financing activities will go in financing cash flow. Okay, this is what you need to know. Now, of course, I am not discussing how to prepare a cash flow statement and all. We had extensively discussed that. I had shown you how to prepare. We had solved so many questions. Now, which cash flow, operating, investing, financing, which among these cash flows can be prepared using two different methods? Operating cash flow. Which are those two methods? Direct and indirect method. Indirect method, what is the starting point? Net income. In net income, you add back all the non-cash charges, and any gain on sale of asset you subtract, because it technically forms a part of investing. Any loss on sale of asset you add back, again it forms a part of investing. So remove these effects by adding or subtracting. And now comes the working capital adjustments. I had given you a simple shortcut. All the current assets and operating cash flow have what sort of relation? Inverse relation. All current liabilities and operating cash flow have direct relation. Please strictly follow this shortcut only in case of indirect method. Okay, direct method, I had logically taught you how to prepare cash received from customers. The starting point, we used to take sales, break it up into two parts: cash, credit. Then unearned revenue is something that you need to be very careful about when it comes to sales. When it comes to COGS, we used to break it up into two parts: fresh purchases, existing inventory. Fresh purchases we used to break up into two parts: cash, credit. Again, we had solved a lot of questions. Please practice those questions. Okay. Then when it comes to investing cash flow, that reconciliation I had shown you, because profit on sale of asset is what? Cash received minus gross book value or net book value? Net book value. Net book value is after considering accumulated depreciation. So now for this, we had done one question where I had shown you the reconciliation. Opening value of accumulated depreciation plus depreciation of current year minus depreciation pertaining to the sold asset gives you closing accumulated depreciation. Likewise, for gross assets, we had done the same thing. Beginning value of gross assets plus new assets purchased minus assets sold gives you closing gross assets. Yes, please be very careful with respect to all these calculations. Okay, now what if you are my bondholders and I'm not able to repay money, so I give my company's shares? Will this come on cash flow statement? No, it won't form a part of cash flow statement because it's a non-cash transaction. It will only be included in the notes as a supplementary information. Please be careful. Depreciation will come under indirect method because it's a non-cash charge, we add back. But when it comes to direct method of operating cash flow, we do not do anything relating to depreciation. There it is simple cash to cash relation: cash received from customers minus cash paid to suppliers minus cash paid for wages minus cash paid for interest minus cash paid for taxes, and finally you get operating cash flow. The operating cash flow which you get by using direct and indirect method, is the final answer going to be same or different? Same, just the presentation method is different. Under US GAAP, there was one requirement: as a company, if I prepare the cash flow statement using the direct method, in notes to accounts, I will have to show the cash flow using indirect method also. Okay, and which one is better among the two? I would say indirect method because it shows the difference between net income and actual operating cash flow, right? Okay, fine. Then this chapter also had a few ratios. Every ratio took into account CFO, cash flow from operations, because that is the heart of any business. How much the cash business is generating from its operations. So that is very important. Okay, so have a look at those ratios once. And after this, FCFF and FCFE, if you remember, free cash flow to equity will be what? Net income plus non-cash charges minus working capital investment minus fixed capital investment plus net borrowings. Remember? Okay, I can write this in one more way. I can write this using one more method. This I will write it as CFO, cash flow from operations minus fixed capital investment plus net borrowing. Okay. After this, we had calculated one more thing, which was FCFF. FCFF is net income plus non-cash charges minus working capital investment minus fixed capital investment plus interest net of tax. Because FCFF is free cash flow to the firm, so I have to include that component also, which belongs to the debt holders. I can write this in one more way. Combining this three will give me what? CFO, cash flow from operations minus fixed capital investment plus interest net of tax. I had shown you the entire derivation of this formula. Okay, how is it derived? We had made two equations and all, if you remember. Okay, not going into that much depth right now. So this was all about cash flow statement. Okay, any doubts that you have in cash flow statement, please let me know. Now it's the time to discuss new chapter, inventories. Okay, which popular methods of inventory accounting? FIFO, LIFO, weighted average, and then two more we had discussed, specific identification and retail method. If a company is following IFRS, the inventory has to be recorded on balance sheet at cost or NRV, whichever is lower. NRV, net realizable value, is what? Sales price minus selling cost. Okay, sales price minus selling cost. Irrespective of the method that you use under IFRS, it has to be cost or NRV, whichever is less. Does IFRS allow LIFO? No, LIFO is banned under IFRS. Okay, now discussing about US GAAP. In US GAAP, if you follow the LIFO method or the retail method, the inventory has to be recorded on balance sheet at cost or market, whichever is lower. And market is also called as what? Replacement cost. Now there is a way to determine this replacement cost, market, which is also called as replacement cost. You have to establish a range, guys. The range, upper range has to be NRV and the lower range has to be NRV minus a normal profit margin. What if the replacement cost exceeds the upper range? Do I let it exceed? No, I have to cap it to the upper range. What if replacement cost goes below the lower range? Do I let it go? No, I have to floor it to the lower range. What if replacement cost is in between the two values? I take it as it is. So that is how my market is determined, and cost or market as per the two, whichever is lower, at that price the inventory will be recorded on balance sheet. In US GAAP, if you are following any method other than LIFO or retail, then it's the same like IFRS. You record it at cost or NRV, whichever is lower. Clear? Okay. Now, when it comes to inventory write down, does IFRS allow inventory write down? Yes, of course you have to write down the inventory. But when it comes to inventory write back, does IFRS allow? Yes, but only to the extent of original cost. When it comes to US GAAP, inventory write down is allowed, but inventory write back is not allowed. It's prohibited under US GAAP. Okay, fine. There was one exception, however, both under IFRS and US GAAP. If you are in the business of any agricultural products or commodities, inventory always has to be recorded on balance sheet at NRV, net realizable value. So then whatever be the NRV, you have to record it at that. Remember this? Okay. By the way, when you write down the inventory, where is that write down ka cost included? Do you include a separate line item for that, or you add it to COGS? Add it to COGS. Add it to COGS. Remember that. Okay, fine. And when inventory write back happens, talking about IFRS, you subtract it from COGS. Okay, fine. Now, one thing I had specifically told you to remember as in understand logically, in an inflationary environment, LIFO always results in lower gross profit and FIFO results in the highest gross profit, weighted average in between the two. So in an inflationary environment, gross profit under weighted average method will be higher as compared to LIFO but lower as compared to FIFO. As regards ending inventory in an inflationary environment will be highest under FIFO. FIFO is first in first out. The cheaper items are assumed to be sold first. So what is there in your inventory? The most recent expensive items. So ending inventory will be the highest under FIFO. In an inflationary environment, it will be lowest under LIFO and weighted average beach ka. Higher as compared to LIFO but lower as compared to FIFO. Remember that? Okay. Now when it comes to deflationary environment, it's exact mirror image of inflationary environment, exact opposite. So you remember any one, the other you will automatically remember. Okay, fine. Then I had taught you a very important concept of LIFO reserve. I had taught you 4 adjustments pertaining to LIFO reserve, and that is to be done when I'm comparing a US GAAP company with an IFRS company, because US GAAP company allows LIFO, IFRS does not. So comparison as such is not possible. So before comparing, I will have to make 4 such adjustments. Adjustment number 1, add a LIFO reserve to LIFO ending inventory under US GAAP. Adjustment number 2, adjust cash balance, LIFO reserve into the tax rate. Adjustment number 3, adjust equity, LIFO reserve into 1 minus the tax rate. These 3 adjustments pertain to the balance sheet. Now one adjustment pertains to P&L. FIFO COGS is equal to LIFO COGS minus change in LIFO reserve, which is nothing but ending LIFO reserve minus beginning LIFO reserve. Okay, fine. Remember these adjustments? I had shown you with numbers, everything was tallying. Okay. Then we had done perpetual versus periodic inventory recording system. Under both the methods, FIFO will produce the same answer. You follow perpetual or periodic, the ending inventory and COGS will be the same under FIFO. But LIFO will give different answers if you follow periodic versus perpetual inventory recording. Periodic was what? You record the inventory at specific intervals, say every 3 months, every 6 months, etc. Perpetual was on a continuous basis. Okay, fine. Then we had done the concept of LIFO liquidation. LIFO liquidation is when you sell from existing inventory. And LIFO liquidation as a concept, remember, will only be applicable in case of US GAAP because LIFO is allowed there only. So in an inflationary environment, LIFO liquidation always results in higher gross profit because you are selling from your existing inventory and you are not selling it from your fresh manufactured items. And inflationary environment has, so the fresh manufactured items will be more expensive. That is why, since you are selling it from existing inventory, LIFO liquidation always results in higher gross profit in an inflationary environment, and in a deflationary environment the case will be reverse. Yes, you remember that. But the point was that we had also discussed how sustainable is LIFO liquidation profit. The profits are not sustainable in a LIFO liquidation. Can you go on selling without manufacturing anything new? No. Okay. Now when it comes to disclosure part, I had specifically told you to read the disclosure part carefully. When it comes to a manufacturer, there will be 3 types of inventory: raw material, work in progress, and finished goods. But when it comes to a trader, it will be only finished goods. Yes, and you have to also mention that how much is the value of collateral that you have kept against a bank loan, and that collateral could be inventory. So we are learning inventory chapter, so I'm saying that inventory could be the collateral. You have to mention the value of that. So for example, I may have taken a loan of 200 crore and in exchange of that I may have kept inventories as collateral worth 300 crore. So I have to mention that in notes to account. I had practically shown you also, if you remember. Okay. And in US GAAP also you have to show all the disclosures. Naturally in IFRS disclosures there will be nothing pertaining to LIFO. And naturally in US GAAP disclosures there will be nothing pertaining to inventory reversal, that reversal of the write down. Okay, because it's not allowed under US GAAP. Remember all this? Okay. Anything else that you need to know? Also, the same thing applies in case of inventory, expensing versus capitalization. All those costs necessary to bring the inventory to working condition have to be capitalized. The same what we discussed for assets, long-term assets. Also, we had specifically discussed about storage cost. If you remember, what to be done with storage cost? It depends. If say I am in the business of manufacturing wine, storage cost is critical for me. It's important in the manufacturing process, so I capitalize the storage cost. But say if I am manufacturing shoes, for example, storage cost is not important for me, so I will expense it off. What about selling, general and admin expenses? Expense. Were they necessary to bring the inventory to working condition? No. So you expense it off. Okay, fine. Again, I would here say that be very careful about the ratios, inventory turnover ratio and all that. Okay, anything else that I'm missing out on, please let me know. Okay, now let's discuss long-term assets. Long-term assets, to a great extent we have discussed in balance sheets, the breakup of tangible, intangible assets, that, and let's discuss the incremental part now. Impairment. When it comes to IFRS, how do you impair an asset? Check if carrying value exceeds the recoverable amount, and recoverable amount is the higher of value in use or NRV. Value in use is what? Present value of all the future cash flows. So you have to discount those future cash flows at an appropriate discounting rate. NRV is sales price minus selling cost. Okay. If carrying value exceeds the recoverable amount, you impair it to the extent of difference between the two. But if carrying value is less than recoverable amount, simply do not impair. Also remember one thing, IFRS allows either the cost model or the revaluation model to record a long-term asset. In case of US GAAP, only the cost model is allowed. And let me tell you one thing, that impairment will come into picture only if the company follows cost model. Hey, how do I know whether the company is following cost model or reval model in IFRS? Notes to accounts it will be mentioned. Okay, fine. So this is impairment treatment under IFRS. What are the two effects? You reduce the carrying value of the asset, and the second effect was that P&L debit, you record the impairment charge. It's a non-cash charge, so while preparing cash flow from operations under indirect method, you will have to add back impairment, right? It's a non-cash charge. Okay, so you should be now able to link things. Okay. Under US GAAP, how to record impairment? There are two steps. Step 1, check if carrying value exceeds the undiscounted cash flows. If yes, move to step 2. In step 2, you check if carrying value exceeds the fair value. If yes, you impair it to the extent of difference between the two. Please let me make one thing very clear. You only take fair value in step 2 and not the NRV. They might give selling cost and all to confuse you. Please don't get confused. Okay, fine. If there exists a case of impairment in US GAAP, yes, I will impair it. But when it comes to impairment reversal, is it allowed under IFRS? Yes, it's allowed only to the extent of original cost. Is it allowed under US GAAP? No. US GAAP prohibits impairment reversal just the way US GAAP mein inventory write back was prohibited. US GAAP is very conservative by nature. Okay, fine. Now let's discuss held for sale assets. There are two assets, held for use, held for sale. There were two specific things in held for sale assets. Point number 1, if an asset is classified as held for sale, stop depreciating. Point number 2, US GAAP, we just discussed, does not allow impairment reversal, but if an asset has been classified as held for sale under US GAAP, you can reverse the impairment, but only to the extent of original cost. Remember that. Okay, fine. In case of reval model, which is only applicable in case of IFRS naturally, what is the accounting treatment? If there is an upward revaluation, where does it go? OCI. If there is a downward revaluation, OCI. So for example, first year mein there was an upward revaluation of 5, I put it in OCI. Now second year there is a downward revaluation of 5, I will put it in OCI. Nullified. Okay, now let's take a new case. If there is an upward revaluation of 5 in first year, let it go in OCI. But if there is a downward revaluation of 7 in second year, 5 will go in OCI, and over and above that 2 will go in P&L. But let's take a new case now. First time only there is a downward revaluation of 7, that entire 7 will go in P&L. Okay, that entire 7 will go in P&L. Subsequently, if there is a reversal, if there is an upward revaluation of, let's say, 10. So 7 will go in P&L and over and above that 3 will go in OCI. Okay, please be very careful with respect to the reval treatment. Okay. Now we had also discussed the profit or loss on sale of an asset, cash received minus net book value. Okay, fine. Then we had learned 3 new ratios in this chapter. Average age of the assets. Average age of assets was what? Accumulated depreciation upon depreciation per year. It is an average calculation, not an exact calculation. And remaining useful life of the asset was what? WDV, written down value upon depreciation per year. You add up the two, you get the total life of the asset. Why was this calculation important? Because the analyst can come to know how much is the productive capacity of the company, does the company need to invest in any new assets in the near term, etc. Also, these ratios you have to calculate as an analyst, or will they be mentioned in notes to accounts? You have to calculate as an analyst. The numerator denominator details, of course, you can get it from the financial statements. Okay. And now as regards the disclosure part, please read the disclosure part very carefully. Okay. In this again, same things like inventory, the collateral value and all has to be mentioned. In IFRS, there was one more specific requirement when it came to long-term assets. Does the firm have any firm commitments over the next 5 years to purchase assets and all? I had shown you in the notes to accounts. Okay. So read all those things. Yes, any doubts here? Anything that I'm missing out on? Please alert me ASAP. Yeah, this is very important. Classification of expense by function, classification of expense by nature. Classification of expense by function means depreciation. If it is pertaining to factory operations, I will put it in COGS. If it is pertaining to R&D operations, I will put it as a part of R&D. I won't have a separate line item for depreciation. This is called classification by function. If it is classification by nature, then I will have a separate line item for depreciation. I had shown you the P&L where there was separate line item for intangible asset ka amortization and impairment of intangible assets. There was a separate line item, but the same case was not there for depreciation. So depreciation in that company was recorded using classification by function method, and impairment in that intangible assets ka impairment and what you call it, amortization was classified using expense by, classification by nature. Okay, remember? Fine. How do I know whether an expense has been classified as function or nature? Notes to account. Every detail will be mentioned in notes to account, so no stress about that. Okay. Anything that I'm missing out on? Barter exchange. Fine. Now, barter exchange. Point number 1, if you want to calculate profit or loss, sales price minus carrying value of old asset. Carrying value of old asset. Sales price, what do you consider first step mein? Sales price as fair value of old asset. If that is not known, go to step 2. In step 2, you take sales price as fair value of new asset. And carrying value of old asset to remains constant because that is known. What is there on your balance sheet? And the last and final step, if you don't know fair value of new asset also, it could be so possible. So then go to step 3. In step 3, sales price has to be considered as carrying value of old asset. And as I said here, carrying value of old asset remains constant. So tell me guys, what will be the profit or loss? 0. If you come till step 3, profit or loss will always be 0. Clear treatment? Okay, fine. I think I've covered everything. Not missing out on anything, no? Please let me know. Okay. Now is the most important part, long-term liabilities and the monster lease accounting. Which are the two types of leases? Finance lease and operating lease. 5 conditions for a finance lease. Tell me, all the 5 conditions should be satisfied or any one condition? Any one also, if it is satisfied, it will be classified as finance lease. Let's discuss those conditions in no particular order. Point number 1, the ownership of the leased asset automatically transfers to lessee at the end of lease term. Second, the lessee has an option to buy the asset at the end of lease term and is expected to exercise it. Third, the lessee uses the asset for majority of the asset's useful life. Fourth, the lessor has no other use for the asset. And fifth, present value of lease payments is at least equal to or exceeds the fair market value of the asset. If none of the 5 conditions are satisfied, it will be an operating lease. Now, why do we distinguish between a finance and operating lease? Is simply because accounting treatment differs for a finance and operating lease. Let's understand the accounting treatment now. When it comes to IFRS, and I'm only discussing right now the accounting treatment in the books of lessee first, then we'll discuss about lessor. Do you distinguish between a finance and an operating lease? No, not required when it comes to IFRS lessee. Treatment is the same under both finance and operating lease. On the balance sheet, you record lease liabilities at the present value of the lease payments. Whatever the lease liabilities, you keep on reducing it by the principal portion. And on the asset side, you record an equivalent value, ROU asset, right of use asset, and you amortize it how? SLM, straight line basis, you amortize it. Okay. Now, this was the treatment on balance sheet. What is the income statement treatment? What all will go in interest statement? Income statement. Interest will go in income statement and amortization will go in income statement. And as regards the cash flow statement, cash flow, what will be the treatment? Whatever the lease amount you pay, break it up into 2 parts, principal and interest. Principal and interest. Now, principal portion will go in cash outflow from financing activities. Interest will either go in operating or financing because IFRS allows a choice. Yes? Okay. Now, same treatment, lessee, operating or finance lease. Any doubts in this? Let's discuss now accounting treatment in the books of lessee under US GAAP. US GAAP. Now let's discuss under US GAAP. Same to same treatment in the books of lessee when it comes to finance lease. Same to same treatment. Just that one thing you need to be careful. Interest paid under US GAAP is always operating. Okay. Rest all same. But when it comes to accounting treatment under operating lease under US GAAP in the books of lessee, there were a few differences. Please be very careful when I discuss this. Amortization here will not happen on straight line basis. I am talking about US GAAP operating lease in the books of lessee. The amortization will happen in the same amount as the principal repayment every year. Secondly, P&L mein I won't show interest and amortization separately. I will show lease expense as a single line item. And on cash flow statement, the lease payment, entire lease payment, I won't break it up into principal and interest part. It will form a part of operating cash flows, operating cash outflows, entire lease payment. So if I have to summarize in simple terms, out of 4 accounting treatments, how 4? 2 of IFRS, operating financing, and 2 of US GAAP, operating financing in the books of lessee. 3 are the same, exact same. IFRS finance, IFRS operating, US GAAP financing. Just US GAAP operating was notorious to have different treatment. Okay. Done, treatment discussion done in the books of lessee. Now let's discuss in the books of lessor. One good thing about accounting treatment in the books of lessor is it is same in IFRS and US GAAP. So you are spared that. Okay. Same under IFRS US GAAP. So now let's discuss accounting treatment in the books of lessor. First, let's discuss for finance lease. First of all, derecognize the asset from the balance sheet. Derecognize the asset and any corresponding gain or loss you have to book it. Then the lessor on the balance sheet records what? Lease asset at the present value of lease payments and keeps on reducing it by the principal receipts. Principal receipts. no touching the liability side because it is not a liability for the lessor. Since the lessor has derecognized the asset, the lessor cannot charge depreciation on the asset. Okay. Now when it comes to P&L, what will go in lessor's P&L? Only the interest income will go in lessor's P&L. When it comes to cash flow statement for the lessor, be it financing or operating lease, it is always operating cash flow. Simple straightforward treatment. Okay. This was accounting treatment for finance lease. When it comes to accounting treatment for an operating lease in the books of lessor, super simple treatment. Don't touch the balance sheet at all. Let lessor retain the balance sheet on his own asset. Whatever lease rentals the lessor is getting, he will simply credit it to P&L, the entire lease rental. And cash flow statement, as I said, it will always form a part of CFO, cash flow from operations for the lessor. Is this clear enough? Okay, fine. I have given you notes also for this, so you please save those notes. Okay. When it comes to low value leases, what are low value leases? Anything up to $5,000 or anything up to 12 months. Do you do such complicated treatments? No. The lessee simply debits the expense, lessor simply credits the income. That's it for low value leases. Clear? And one more thing that you have to bear in mind is that US GAAP operating lease treatment in the books of lessee was slightly different. That lease expense was shown together in P&L and all, and that created major differences. That one table is given. Oh my god, that in my opinion is highly testable. So please do that carefully. Okay, fine. Anything else that you need to know? This was all about lease accounting. Okay. That lessor ka one thing that you need to know, sales type lease and direct finance lease. In sales type lease there will be a profit or loss. In direct finance lease only the interest income. Okay, fine. Proceed. Now let's discuss the accounting treatment of DBO, defined benefit obligation. Defined contribution plan was there, defined benefit plan was there. Defined contribution accounting is very straightforward. The investment risk is on whom? Employees. In defined benefit plan, the investment risk is on the employer. So accounting gets complicated. I had shown you one entire numerical in the class, how to do it. Discounting and all those components are involved. Okay, you won't be expected to solve numerical questions on defined benefit obligations accounting at level 1. Okay, it's a part of level 2. I just explained that so that you have a better understanding. Now just let's discuss the accounting treatment in IFRS. What all will go in P&L? Current service cost, past service cost, interest on beginning PBO will form a part of P&L, and in P&L credit side, expected return on plan assets. Guys, tell me one thing, expected return on plan assets, which rate do you use? Any separate rate or the discounting rate? Discounting rate only. When it comes to OCI, actuarial loss, AL is actuarial loss will go in OCI debit, actuarial gain will go in OCI credit. What other thing will go? Difference between actual and expected return. If actual return exceeds the expected return, you put it in OCI credit. If actual return is less than expected return, you put it in OCI debit. Okay, I'm not writing it, you understand. Fine. Now when it comes to US GAAP, the treatment is slightly different. US GAAP mein what will happen? In P&L, past service cost won't go in P&L, it will form a part of OCI. And expected return on plan assets, you can use any rate that you want under US GAAP. But when we see it on a combined basis, P&L plus OCI combined, it's going to be the same under IFRS US GAAP? Yes. And what is that combined cost called? TPPC, total periodic pension cost. Okay, remember this. So this much is relevant at level 1 that you need to understand. Okay, fine. Now, when it comes to accounting for share-based payments, I had taught you 3 products. Restricted stock grants, restricted stock units, and ESOPs, employee stock option plans. Accounting was largely the same. In case of restricted stock grants and restricted stock units, what's the main difference? Restricted stock grant owners, they get dividends, they get voting rights. Restricted stock unit holders don't get anything of that sort. So today I give RSUs. First, let's discuss restricted stock grants. Let's discuss about restricted stock grants. Today is the grant date. I give 1 lakh shares into, I will have to consider what? Fair market value of the shares. Okay, if it's a listed company, I can easily know that. But if it's an unlisted company, I will have to get the valuation done. Okay, fair market value of shares and the vesting period, or you also call it as exercise period, is 3 years. So I will have to distribute this cost over 3 years. Okay, and the date on which the employee becomes eligible is called the vesting date. Fine. What if there are subsequent changes in fair market value of the asset? Do you consider that or ignore that? Ignore that. I had explained you the logic. Now when it comes to restricted stock units, accounting treatment is largely the same except for one difference. This fair market value may say you will have to subtract the present value of future expected dividends, okay, since you are not paying dividends to the restricted stock unit holders. Now when it comes to ESOPs also the accounting treatment is largely the same, but instead of fair market value of shares, I have to consider the fair market value of options. And you know, those complex models like Black-Scholes model are to be used in valuing an option, and again to be distributed over the vesting period, maybe 3 years, 4 years, whatever, on a straight line basis. Okay, then we had discussed stock appreciation rights. Stock appreciation rights are equity settled or cash settled? Cash settled. Okay. Then you remember share-based compensation reserve, whatever expense was here, I pass it on to share-based compensation reserve. Then at the end of the vesting period, I reclassify it to equity share capital, and over and above the face value to reserves and surplus. Yes? Okay, fine. And then we had discussed the implications. The employees may be averse to taking risk, the employees may start taking on more risk and all. ESOPs are given to align the employees' interests with those of shareholders and not the management, remember. Okay, so that was the theoretical part, but accounting treatment you have understood. Okay, in ESOPs, will there be cash inflow to the company? Yes, there will be cash inflow to the company to the extent of the strike price, which is also called exercise price, but only when the market value of the shares exceeds the strike price. Otherwise, the employee won't be incentivized to exercise the ESOPs. In case of restricted stock grants and restricted stock units, there will not be any cash inflow to the company. The company gives it free of cost to the employees. Yes? Okay, fine. Any doubts here? Okay, so this was largely that we had covered in long-term liabilities. Any other doubts that you have? Also, when it comes to presentation of defined benefit obligation, if the plan assets exceed the PBO, projected benefit obligation, you net it off and show it as a net pension asset. If plan assets are less as compared to the PBO, you net it off, show it as a net pension liability. Okay, fine. Just a presentation issue, nothing else. Anything else that you need to know here? Okay. What was the next chapter? Income taxes. Let's discuss income taxes. So we had discussed terminologies pertaining to books of accounts. 7 terminologies we had learned in books of accounts. Number 1, pre-tax income. Okay, the income as per books of accounts on which you pay tax. Second, income tax expense. What was the formula for income tax expense? Taxes payable plus change in DTL minus change in DTA. Change in DTL simply means ending DTL balance minus beginning DTL balance. Change in DTA also means the same thing. Okay, ending DTA balance minus beginning DTA balance. Second term was income tax expense. Third and fourth you already know, DTA, DTL. Fifth and sixth you already know, temporary difference, permanent difference. Temporary difference is also called as reversing difference, also called as timing difference. Tell me one thing, DTA, DTL, they arise only because of temporary difference or because of permanent difference too? Only because of temporary difference. Permanent differences do not give rise to DTA, DTL, remember that. Okay, and the 7th term was carrying value. Carrying value is the book value of the assets. You recall these 7 terms? Now let's learn the 5 terms under income tax terminology. First was taxable income, the income on which tax is calculated. Second term was taxes payable. Third is taxes paid. Fourth is tax base. Tax base is nothing but carrying value as per the tax records. And last but not the least, 5th one is what? tax loss carry forward. And we had discussed one thing, tax loss carry forward always results in what? DTA, because it is going to give you future benefits in the form of a set off against your future taxable income. There were two methods of determining DTA, DTL. The second method is more appropriate, the carrying value and the tax base method. Whenever carrying, you have to just remember this one thing, whenever carrying value of the asset exceeds the tax base of the asset, you record what? DTL. The moment you remember this, the rest three are free for you. Carrying value of asset whenever is less than tax base of the asset, it results in DTA. Whenever carrying value of liability exceeds tax base of liability, it will create a DTA. And finally, when carrying value of liability is less than tax base of liability, it results in DTL. Please be very careful about this. You may be asked, what is the effect of impairment on DTA, DTL? So let's discuss now. If there is impairment, what happens? Carrying value of the asset reduces. So carrying value of asset will be less. Tax base won't be reduced. So then in that case, your tax base of the asset exceeds the carrying value and hence you will record a DTA. This is how you should be linking it. Okay, due to impairment, it will result in creation of a DTA. Clear? Okay, fine. Now, whenever you calculate the DTA DTL balance, how it is calculated? So for example, carrying value of asset exceeds the tax base. So whatever is the difference multiplied by the tax rate results in DTL. The point is, will you use the current tax rate or future effective tax rate? Future effective tax rate. I had explained you the logic because these balances are going to be utilized in the future at the applicable taxes at that point of time. If you have a DTA or a DTL balance and if the future tax rate increases, the DTA DTL balance will increase. If you have a DTA or a DTL, whatever you are generating, and if future tax rates reduce, the DTA or DTA balance will reduce. Now remember one thing, income tax expense is equal to taxes payable plus change in DTL minus change in DTA. Now, if your DTL balance increases because of an increase in tax rate, ultimately your income tax expense will increase. But if you have a DTA balance and if tax rates increase, your DTA will increase and ultimately income tax expense will reduce. I had told you some terminologies which you have to be careful about. Income tax expense, the other name for that is provision for taxes. Provision for taxes. Taxes payable, other name for that is current tax. Current tax. And DTL, DTA cumulatively you call it deferred tax. Okay, do you remember all this? Now I have a DTA balance, remember, and I feel that there will be no sufficient future taxable income such that my DTA is worthless. What do I do? Can I write it off? Yes, by a contra asset account called as valuation allowance. So now your DTA balance will be reduced and that balance will be transferred to valuation allowance. Subsequently, if I feel that, oh no, I will have future taxable income, can I write it back? Yes. Under both IFRS and US GAAP, you can write it back. And here I had taught you how earning smoothing happens then. Okay, fine. If you have DTL balance, if the firm has DTL balance and it is not expected to reverse in the foreseeable future, you treat it as liability at its full value, if you remember that. When you are projecting income statement, which income tax rate do you use? The statutory tax rate, the effective tax rate, or the cash tax rate? The effective tax rate is used to project income statement. When you are projecting cash flow statement, the cash tax rate is to be used for projecting cash flow statement. Cash tax rate was what? Cash tax paid upon pre-tax income. If this is the cash tax rate, cash tax rate. Effective tax rate was income tax expense upon pre-tax income. Remember? And statutory tax rate was the rate prescribed by government authority. Now, there could be a difference between effective tax rate and statutory tax rate only in case of permanent differences. That reconciliation will have to be shown in notes to accounts. I had shown it to you. And if there is no permanent difference at all, the effective tax rate and statutory tax rate will be the same. Okay, fine. This is all we had discussed here. This is all that was covered here. Okay, fine. Any doubts? Okay. Now we discuss financial reporting quality. Okay, the 6 rankings. First of all, before 6 rankings, 2 things important in this chapter: earnings quality and financial reporting quality. Earnings quality, good means sustainable earnings and adequate return on investment. Financial reporting quality, good means relevance and faithful representation. Now let's discuss the 6 rankings. First 4 rankings, were the financial statements GAAP compliant? Yes. And when I say GAAP, it means both IFRS and US GAAP. Okay. And comments. Now let's discuss the comments. First ranking, earnings quality good, financial reporting quality good. Second ranking, earnings quality poor, financial reporting quality good. Third ranking, biased accounting choices. I had given an example of cash flow statement, interest treatment. Fourth comment was active management of earnings management. Fifth and sixth, GAAP compliant? No. Fifth was earnings quality, good. And sixth was fraudulent, fictitious events. Yes? Okay, fine. Now, what are the reasons for doing such, accounting frauds and all that? There were 3 reasons: opportunity, motivation, rationalization. Opportunity, weak internal controls, ineffective board of directors, all that. Motivation, search for a personal bonus, attention to future career opportunities, etc. Rationalization was corporate concerns about financing in future, obtaining board approval and all that stuff. That is rationalization. Should you follow conservative accounting or aggressive accounting? Neutral accounting, neither conservative nor but if accounting standards impose conservatism on you and you follow accounting standards, you are said to be following neutral accounting. Okay, you did not do out of your own choice. That is because accounting standards told you. Remember this. What if you present a non-GAAP measure? Is it okay? Yes, it is okay, provided 2 reasons exist. Reason number 1, you have a reasonable justification for doing so and you feel that that will result in a better presentation. Point number 2, you show a reconciliation. Had you followed the GAAP measure, what would have been the quantification? Had you followed non-GAAP measure, what is the quantification? So that users understand. Okay, fine. Now, this chapter discussed all the possible fraudulent methods which the companies can follow, which we have discussed extensively over the course of learning FSA, that valuation allowance, bad debt expenses and whatnot. Okay, earning smoothing, channel stuffing. Yesterday I had taught you what is channel stuffing, etc. Fine. And questions also, if you see, a lot of questions will be tested, if at all, in this chapter, from aggressive accounting policies, conservative accounting policies. What is aggressive accounting? Showing more income, less expenses. Conservative accounting is showing more expenses, less income. Then we had discussed that conservative accounting in the current year will result in lesser profits. Aggressive accounting will result in higher profits in current year. Then earnings management also we had discussed it of 2 types. Earning management as a result of real action. Earnings management as a result of accounting choice. Okay, fine. So please do the questions carefully. Nothing much here. Okay. Now let's discuss financial reporting quality. Financial analysis techniques, financial analysis techniques, ratios extensively. 5 broad types of ratios: liquidity, solvency, efficiency, profitability, valuation. Valuation ratios will be covered in equity. Let's discuss the other 4 ratios, out of which liquidity, solvency I have already discussed with you, so not repeating the same thing again. Efficiency ratios, also called as performance ratios, also called as activity ratios. Debtors turnover, creditors turnover, inventory turnover. Debtors turnover is what? Sales upon average receivables. Inventory turnover, COGS upon average inventory. Payables turnover, purchase upon average creditors, right? Okay. Now these ratios, turnover ratios, give birth to number of days of receivables, number of days of inventory on hand, which will simply be 365 upon the respective turnover ratio. Number of days of receivables, that is days sales outstanding, plus number of days of inventory on hand, lower the better. Number of days of payables, higher the better. Operating cycle is what? Number of days of receivables plus number of days of inventory on hand, lower the better. Cash conversion cycle is operating cycle minus number of days of payables, again lower the better. Can it be negative? Yes, of course it can be negative. Okay, fine. So this was, then asset turnover is sales upon average assets, higher the better, indicating efficient utilization of assets. Working capital turnover, sales upon average working capital. I had taught you the disrespect respect method. Follow that for any turnover ratios. Okay. Then there was profitability ratios, the most basic ones: net profit margin, gross profit margin, operating profit margin. Any margin, when you say, it is upon sales. Okay, operating profit is what? EBIT. Don't include other income in that. I had shown you practically also. Okay, then there was return on equity, net income upon average equity. Now here is where the DuPont analysis comes in very handy. Traditional DuPont and extended DuPont. Traditional DuPont is net profit margin into asset turnover into financial leverage. I had shown you one method to remember that. You know, you don't need to actually by heart all these multiplication stuff and all that stuff. Logically you can derive it. Return on equity, extended DuPont, is tax burden into interest burden into operating profit margin into asset turnover into financial leverage. Tax burden high means what? Essentially tax burden high means tax rate is low. Interest burden high means interest rate is low. So don't be misled by the name burden. Burden higher the better it should be. Okay, fine. Tax burden is also called as tax retention rate, which is nothing but 1 minus the tax rate. Okay, fine. Now going forward, return on capital employed was not a part of your curriculum, just taught you for a better understanding, so not discussing that. Return on invested capital is what? Net operating profit after tax, which is nothing but EBIT net of tax upon average invested capital. In average invested capital, you do not include cash and cash equivalents. Okay, only the long term capital, debt and equity. Then we had discussed return on assets, net operating profit after tax, which is EBIT net of tax, numerator same as ROIC, upon average total assets. Here you include all the total assets, okay, but on an average basis because it's a mixed ratio. Okay, pure P&L, pure balance sheet, mixed ratios. I hope you know the basics. Okay. Apart from this, was your other specialized ratios of the respective industries. You need not remember, just for better understanding we had discussed it. Okay, then sensitivity analysis, scenario analysis. Scenario mein which are the three scenarios? Base case, best case, worst case. Sensitivity analysis I had practically shown on Excel how is it done, changing one or two inputs and seeing its effect on other inputs. Now when it comes to the questions of financial analysis techniques, I had told you one shortcut to solve questions, the smart way of solving questions. Don't sit to solve each and everything. That hint I had given you how to quickly solve questions. Okay, fine. Anything else that you need to know from this chapter? Anything else that we are missing out on? Okay. In the last chapter, financial statement modeling, it is all about projections and projections, for which you need to have company knowledge, industry knowledge and everything. And financial modeling, typically I would advise you to read this chapter only once you are done with the behavioral biases chapter of portfolio management, because a part of that is included in this chapter, and a part of equity also is included in this chapter, Porter's 5 forces. So effectively this chapter should be done at the end. Okay, and solving part in this question, in this chapter, not much as such to discuss. Okay, fine, because financial statement modeling is a course in itself. I mean, it's very vast. Fine. Anything else that you need to know? Okay, helpful? Okay, all the very best.